Hello and welcome to Mint. I am Nasrin Sultana. Today I am joined by Mr. Bill Maldonado. He is a Global CIO of HSBC Global Asset Management Company. Hello Bill, welcome to the show. My first question would be, what's your outlook on the global equities right now?
We're very positive on the global outlook. I think that the market has got too bearish about the chances of a recession in the US, in the world. The market's been worried about that a lot over the last year or two. And that's created very good opportunities for equity investors. It's created good value in equity markets, despite the recent strength that we've seen in many equity markets. And profitability has been improving, and that's the main reason to buy equities. So I think with the Fed now having pivoted to a much more dovish stance, that really kind of underpins the market, and I would say there's reasons to be very positive for equities over the foreseeable future.
Right. So right now the situation is such that global central banks are kind of trapped in an ultra loose monetary policy. Do you think that's going to impact equities, as you mentioned, and how much is going to impact the equities as you foresee in the future?
So it's true to say we're living in a very low growth, low inflation, low interest rate world. We've been in that mode since the global financial crisis. We don't know what's going to happen in the long run, whether we're ever going to revert back to more normal, historically normal rates of interest rates, of inflation, of other economic variables. But what I would say is that for the moment, having an okay growth environment, it's not too hot, but it's not too cold either. It's a little bit of a Goldilocks type environment, and having low interest rates and low inflation is very good for asset prices, especially for equity markets. That's probably the best asset class to own in this kind of environment, and they look pretty attractive.
Right, but also at the same time we are kind of turning to a situation where there is a slowdown economically all over the world. Also there is a protectionism, and there are other factors which are impacting equities. In that scenario, how do you see global equities in 2020, maybe in next 2 years?
Yeah, so look, there's always something to worry about, and in this sort of 24/7 connected world that we live in, where we can all track the news in real time, in kind of every day, every week if we want, I think that we become obsessed with some of these risks. They're geopolitical risks, other kinds of risks out there. The reality is that over any reasonable time frame, over any kind of medium-term time frame, those things matter a lot less than most people believe. What really matters is the underlying economy and growth and how corporates are doing. And the answer is, in this environment now, they're doing just fine. Corporates are profitable, profitability is improving, default rates are falling, if you want to think about it in terms of bonds and fixed income. So as far as we can tell, and we can't see out very, very far, but to 2020, maybe even to 2021, it doesn't look like we're going to slip back into recession, and it looks like corporates are going to continue to do pretty well. So as far as we can see, this is a pretty decent environment. We'd all like it if growth was stronger. We'd all like to go back to kind of more normal rates of interest, but also think about the transition. What would happen if we hit a period of very fast growth and interest rates had to go up? Even though in the back of our minds we all wish for that, and that might be the right thing to wish for socially, that would not be without its problems for asset markets. So actually this is a very decent environment for equities.
Okay, so as we speak, there are a lot of economists in the US especially who had penciled in a kind of recession in the beginning of the year. Do you think those warnings were immature at those time, or do you think that we are kind of slipping into such situation?
It's a kind of a recurring theme. It's a bit, you know, have you seen that movie Groundhog Day, where
Right.
he wakes up every day?
Every day the same
So
thing.
so there's kind of a Groundhog Day on a recession. People keep not wishing for a recession, but they keep seeing it. We had a phantom recession in 2016.
Is there a fascination getting into back to recession?
I don't know. It's like a fear. I mean, after all, we're only human, and we're afraid of many, many things. And it seems that recession is something that people are very afraid of. It's not surprising if you go back to the big recession that we had during the global financial crisis. That was a terrible moment in time for most people, and nobody has any desire to go back to that. But this theme keeps playing out all the time, and people are always looking for the expansion to
But
end.
there
and
is a slowdown in the global economy, isn't it?
it's very minor. So we were growing at above normal historical rates of growth, and that growth has slowed down very marginally back down towards average rates of growth.
Okay.
It's really very minor. I think it's too much of an extrapolation to say, okay, therefore we're going to go into recession. That's extrapolating things much too far. So, but that's what people do. That's what people worry about. The market seems to be very focused on that.
Right.
As I say, we don't think that that's where we're heading in the short to medium term. Longer run, no one can tell.
Right.
A recession could always happen, but it doesn't look like that's where we're heading now.
So moving on to India, what's your sentiment towards India as a destination for investment, and how do you see India vis-a-vis the other emerging markets?
So I would say our sentiment is very positive towards India. The Indian economy has done really very well if you think about it. From an international investor's point of view, growth has been high and quite stable. The economy has been well run, so it's been well run by the central bank, by the RBI, and the government has tended to be very fiscally prudent as well. And so what we've seen is inflation falling and staying low, growth staying at a very, very nice, very reasonable level, and interest rates being able to come down because of that combination of factors. From an international investor's point of view, that's great. The other aspect of India is that it's relatively uncorrelated to the rest of the world. Because the Indian economy is more self-contained than other large economies, it tends to march to the beat of its own drum. And when people are worried about the global economy, when people are worried about China or the US, as we were saying earlier, that's been an on-off theme all the time, then that relatively low correlation, that insulation, if you like, from global variations becomes very valuable, and that's what investors have liked a lot about India. It's sort of become a bit of a safe haven destination.
So among the EMs, does India stand in the top 3, or it is the most preferred destination?
I wouldn't say it's always the best preferred destination, because at least from our perspective, we're very interested in two things. We're always interested in profitability and the things that drive profitability, like the economy, the things I was talking about, but we're also interested in valuation. And the thing about India now is that it's not as cheap as other markets.
Right.
The fundamentals are really, really good. But there are cheaper markets out there. But these things come and go, and there'll be an opportunity at some point for a good entry level into India.
So you're saying basically India is not cheap compared to other EMs, but still is preferred by foreign investors?
Correct. Yes, it's been preferred. And actually, if you look back historically, if you're a foreign investor and you wait until India is cheap before you buy it, you get very few chances. India is a market that hardly ever trades cheap.
Right.
So,
We have been historically expensive.
yes, yes.
Right. So it doesn't kind of deteriorate the kind of interest in India by the foreign investors?
No, because the fundamentals are good. And also in the Indian market, it's a very interesting market because you have different kinds of companies. You have domestic Indian companies focused on the domestic consumer or some other aspect of the domestic economy. You have international companies that really are doing most of their business abroad, owned and run in India. Things like TCS or Infi or these kinds of companies, really most of their business is outside of India. And then you've got truly global companies which happen to be owned or headquartered in India. You could say Tata's a bit like that now because it has a global business that's its growth business in JLR.
Right.
So that gives you a massive amount of choice. And that's great. That's one of the nice features, one of the good features in the Indian market.
So at this moment, I want to point out a few things like the liquidity crisis that we saw last year. There was an NBFC crisis. Also, there was corporate defaults by few companies that we have been seeing over the last few months. Does the foreign investor lose confidence in because of factors like this on India?
Not really. I think what is important is how these things are handled and how they're resolved. I think international investors are well used to these types of events in emerging economies. They happen all over the world all the time, fortunately or unfortunately. So it's not really about the events per se, but about how they're handled and how they're resolved. And I think so far we'd say, so good. We're on a resolution path. The government's been supportive, the central bank's been supportive, very good. So let's see how we go, let's see how it gets resolved.
Right. So after the new government was formed in May, we had the budget in July and there were a few proposals in taxation which kind of had an impact on the foreign investors. It's not very clear how much it will impact as far as the taxation goes. What is your reading into it?
Yeah, look, over the years, and we've been investing in India for a very long time, both domestically and internationally. These issues come up from time to time. So what we see, and not just in India, governments are passing legislation, they're making changes, which is a good thing. That's what investors want, that kind of progressive, more reform-minded government. And from time to time, there are unintended consequences to things that they're trying to do. I don't think it makes any sense to get panicked or worried about that. In our experience, those things tend to work themselves out. Nobody is trying to hurt international investors or stop them coming in or invest in an economy. So my sense is that these things get worked out, and one just has to be patient, one has to contribute constructively to the dialogue, feed the right information in to the right parties, but I have a lot of faith that things are going to be worked out as they always have been in the past.
So you don't think this tax proposals will have any impact on the foreign liquidity coming to India?
I don't believe that that's the intention, and therefore I don't believe that that's going to happen.
Okay. I believe you've gone through the budget proposal for this year. Any take on the kind of proposals and the estimates they have?
Well, I think it's a very fiscally responsible budget, and speaking as an international investor coming into India, that's very good. That's something that investors want to see, and that's important for a country like India, and I think that's the main takeaway, to be really honest, from an international perspective. There's been a lot of reform in the economy, and that seems to be working well, and I think international investors are very keen to find out what's the reform agenda going forward, and having a fiscally responsible budget and government in place is a very good thing.
Right. So my last question is, what do you think would be risks to Indian equity, any foreign investors investing into Indian equities?
There's always risks. This is a growing, developing economy, so there's always risks. I don't think there are any particular risks to the Indian economy. As I've said already, it's relatively insulated versus other similar kinds of economies. That at times of stress can be a very good thing. So I don't perceive there are any particular risks. Of course, if something happens in the world, if there's a big slowdown or something, India won't be completely immune from that. And so those risks are always out there. But I wouldn't say there's anything particular at the moment that we need to worry about.
Thanks, Will, for an interesting conversation. So HSBC Global Asset Management Company is overweight on India, but to some extent they think that Indian is expensive compared to other markets. They're waiting for earnings to catch up to that kind of expensive valuations. We'll have to wait and watch if corporate earnings actually see a revival. That's all for now. Thanks for watching. For more details, stay tuned.